All right, let's dive into the numbers behind Henderson Bank's Q3 FY25 performance. We've got their earnings call transcript, the investor presentation, and their unaudited financials. A real deep dive today. We're going to break it down, see what really matters, and maybe even find a few surprises along the way.
You know what really stands out to me? Having the earnings call transcript, we get to hear directly from the bank, understand their thinking. It adds a whole new layer beyond just the raw numbers.
Totally, like
Well,
peeking behind the curtain, right? So, setting the stage, Q3 FY25 was an interesting time for the Indian economy. Things were stabilizing after a bit of a slowdown.
yeah, and Henderson Bank's managing director actually pointed to a few reasons for that recovery. During the earnings call, they highlighted the comeback of rural demand and the boost they got from the festive season.
Sounds like government spending played a role too, especially for vehicle financing. Be interesting to see how the upcoming union budget impacts that sector. But first, let's zoom in on Henderson Bank's retail banking. Their retail deposit growth really caught my eye. Both compared to last quarter and the same time last year, it's impressive.
And their investor presentation shows that surge in deposits really boosted their liquidity coverage ratio. It's at 46.1% now.
For those of us who aren't financial experts, what exactly does the LCR tell us?
Sure. Simply put, the LCR is a measure of a bank's ability to handle a short-term financial crisis. Higher LCR means they have more assets they can quickly turn into cash if needed, like a financial safety net. So for Henderson Bank, this strong LCR shows they've taken steps to strengthen their financial base.
Makes sense, especially since they also mentioned reducing certain wholesale deposits that weren't really helping their LCR.
Exactly. Shows they're prioritizing stability and balance, not just chasing growth no matter what.
Smart move, especially these days. And that calibrated approach seems to be how they're handling loan growth, too. Being very deliberate about managing growth across their business.
It's all about balance,
Right.
right? Not just lending freely, but being strategic about where and how much they lend.
And some of their new initiatives are really taking off. Their affluent and NRI banking services are showing some pretty impressive growth.
Smart move. Targeting these specialized markets, diversifying their revenue, and expanding beyond their traditional customers.
And their merchant business loan book is up a whopping 32% year on year. That's substantial. What's driving that growth? Are they offering new products or tapping into an underserved market?
Great question. Could be a mix of things, actually. New products, better marketing, even just increased demand from merchants. We'll definitely need to explore that more.
And we can't forget their tech investments. They launched a new digital banking app called Indie. Early signs are positive.
That move towards digital banking is key to their strategy. They're creating a future-proof model, intertwining technology and customer experience.
Absolutely. Could be a major factor in attracting and keeping customers long term. Now let's look at the less exciting but crucial side. Asset quality. Overall, their gross NPA and net NPA figures are 2.25% and 0.68% respectively.
Decent overall, but they did have some challenges, especially in microfinance, where they had higher slippages than usual.
For those not familiar, could you quickly explain gross NPA and net NPA?
Of course, NPAs, or non-performing assets, are basically loans that have gone bad. Borrowers aren't paying as agreed. Gross NPA is the total value of those bad loans, while net NPA is the portion not covered by the bank's provisions.
So lower net NPA is generally better, means they have a bigger cushion to absorb losses.
Exactly. And while the microfinance issue is a concern, it seems mainly limited to that segment. Other areas, like vehicle and corporate banking, remain pretty stable.
Right. Plus, they're seeing improvements in their restructured book, SMA 1 and 2, and the SR book. Positive signs they're managing risk and trying to prevent things from getting worse.
Yeah, like putting out small fires before they become infernos. But let's shift to vehicle financing. Seems like a bright spot for the bank. Their disbursement numbers rebounded this quarter, reversing a downward trend.
And the growth is across different categories. MSVs, construction equipment, two-wheelers, all seeing increases. Clearly, they're adapting to the changing vehicle market.
Definitely. Being proactive and taking advantage of the shifting demands.
But even with that overall growth, there were challenges. Higher slippages in tractors and two-wheelers. Raises an interesting question. Can those positive trends in other vehicle categories outweigh these issues and help the bank's overall stability?
Something to explore as we go deeper into their financials. But now, let's address the big issue. Microfinance. Their subsidiary, Hurrah Financial Limited, is facing some serious headwinds.
Definitely. And while they did mention some improvement in disbursements, their approach to growth in this segment is very cautious.
Understandably so, given the economy and the changing rules in microfinance. They even said during the earnings call that their disbursement rates and criteria for borrowers are more conservative than before.
It's fascinating how they're handling this complex situation.
It is. And their microfinance loan portfolio growth varied geographically. For example, they had sequential growth in Maharashtra and Odisha, but declines in Karnataka and Uttar Pradesh.
Shows how local economic factors play a big role.
Absolutely. Highlights the importance of a diversified loan book, geographically and in terms of loan types.
And to their credit, they've been very transparent about their microfinance operations, providing extra disclosures, especially on disbursement and asset quality.
Transparency is key for investor trust, especially in a sensitive sector like microfinance.
They also talked about the 30 to 90 book metric, which measures loans overdue between 30 and 90 days.
A good indicator of potential stress in the portfolio, like an early warning system.
Luckily, they said this metric remains stable, things aren't spiraling out of control.
Right. They even sounded a bit optimistic, saying the worst of the stress seems to be passing, with fewer customers becoming overdue.
But we can't ignore that they did report higher gross slippages from Part Financial this quarter.
True. Shows they're not out of the woods yet, and microfinance will need careful attention and adjustments.
Despite the challenges, they made it clear they're sticking with microfinance, highlighted their investments in technology, analytics, and people, added about 10,000 employees to Part Financial in the last year alone.
Bold move, considering the current difficulties.
Their plan for managing risk and ensuring stability is multi-pronged. They're focused on funding needs of existing customers and centers, being more conservative about customer debt, investing heavily in collections, and continuing to diversify their loan book.
A comprehensive strategy, aiming to build a stronger, more resilient microfinance business.
But the big question is, will it be enough to weather the storm?
That's the million-dollar question. But let's move on from microfinance for a bit and look at their corporate banking. That's a much brighter story.
Something a bit less stressful. Their corporate banking is doing well. Healthy loan book growth, both year-on-year and compared to last quarter. And it's not limited to just one type of corporate client. They're seeing good numbers across large, medium, and small businesses.
Right, not putting all their eggs in one basket, successfully catering to a diverse range of clients.
And their diamond business is doing well, too. Strong asset quality, even though growth is a bit subdued.
Shows their expertise in a niche area. Diamonds are notoriously tricky to value, prices fluctuate wildly, but they seem to be managing risk effectively.
Also, a large portion of their corporate customers have high credit ratings, A and above. Shows their focus on lending to quality borrowers.
That focus has definitely helped improve their risk profile. Their risk-weighted assets, a key indicator of their portfolio's riskiness, have been decreasing for a few quarters now.
While there were some minor slippages in corporate loans, mostly due to one specific real estate account, their overall annual slippage figures are low and stable. Suggests their risk management practices are working well.
Proof that even well-managed portfolios can have hiccups sometimes.
All right, let's switch gears again and talk about their retail assets. They're seeing positive trends there, too.
Definitely. Especially their MSME book. Impressive year-on-year growth and strong momentum in acquiring new customers. They even highlighted that 80% of their new customers come from the smaller end of the MSME market.
Smart move, expanding their customer base and spreading risk across many smaller loans. Seems to be working, especially with their branch model and new products attracting new clients.
And they mentioned a fully digital lending platform for MSME customers. That emphasis on digital capabilities again.
Definitely a recurring theme. And it seems to be paying off. Their LAP book is growing steadily, and their home loan book is expanding rapidly.
The takeaway is the diversity of their retail asset portfolio. Not relying too much on any one product. Provides a buffer against downturns in any specific market.
And their credit card business is seeing quarter-on-quarter growth in spending, too.
While credit card use is up, they're managing the share of unsecured cards and personal loans carefully.
Important because unsecured lending can be risky, especially during economic downturns.
Shows their commitment to responsible lending and maintaining a balanced risk profile.
Before we wrap up this part of our deep dive, let's touch on their overall liability strength. I was struck by their efforts to optimize their deposit mix.
All right. They're reducing their reliance on bulk deposits, as we discussed, and increasing retail deposits, which are generally more stable.
Exactly. They even mentioned their target range for the LCR and LDR ratios, emphasizing their commitment to a more stable and diverse deposit base.
Building a strong foundation for sustainable growth.
Absolutely. We've got a lot more to cover, but let's pause here for now.
Agreed. We'll take a quick break and then delve into the exciting world of the analyst Q&A from the earnings call. That's where we'll really see how the bank's leaders handle the tough questions.
Welcome back. We're digging deeper into Henderson Bank's Q3 FY25 performance. This time, we're focusing on the analyst Q&A from the earnings call transcript. This is where things get interesting, where the bank's leadership gets put on the spot. Yeah, it's like a financial showdown. Analysts firing tough questions, the bank trying to answer convincingly. What were some of the key concerns analysts raised?
One analyst honed in on the bank's use of their contingency buffer. Remember, they talked about using some of it to cover potential losses? This analyst wanted to know how much went to microfinance versus that corporate account slippage we discussed.
Did they give a clear breakdown?
They did. Clarified that a bigger chunk, 160 crores, went to potential microfinance issues, only 40 crores for the corporate account. That tells us something about where they see the biggest potential for problems.
Seems like they're more worried about microfinance. Speaking of which, analysts really wanted to gauge how bad the situation is. One even asked about overall stress levels, given the bank's already high collection efficiency in their zero DPD bucket.
Right. And the managing director admitted the 30 to 90 book, a key indicator of potential stress, was still high at 4%. Blamed it on some tough months from microfinance back in October and November.
So even with the good signs, they're not out of trouble with microfinance yet. Analysts also grilled them on margins. Wanted to know how they saw margins settling, with interest reversals probably done, and a possible rate cut coming.
Crucial question. Net interest margin, NIM for short, is key to a bank's profitability. Basically, the difference between interest earned on loans and interest paid on deposits.
So, did they say where they expect margins to land?
Not really. The managing director played it safe, no specific predictions, said they need to see how microfinance plays out and wait for the central bank's rate announcements, the classic wait-and-see approach.
Makes sense. Better to be cautious than overpromise. Another hot topic was the new microfinance guidelines, MIN 2.0. Analysts wanted to know how Henderson Bank was preparing, especially for that rule limiting how many lenders a borrower can have.
This is where their shift towards a more granular model comes in. Remember, they've been focusing on smaller loans and a more diverse borrower base.
Right. Sound like that gives them a head start on complying with the new rules.
Exactly. They revealed that a big chunk of their microfinance business, 86% of their portfolio, already follows the new rules, with borrowers having 2 or fewer lenders. Aiming for 95% and 98% compliance soon shows they're proactive about regulations.
That's impressive. Seems like they're well positioned for these changes. But analysts didn't just focus on big regulations. They also dug into specific asset quality concerns, especially those higher slippages in tractors and small commercial vehicles.
Rightfully so. Those segments have been worrying across the industry. Lots of lenders concerned about rising delinquencies.
So how did Henderson Bank address those concerns?
They faced the issue head-on, admitted they'd seen more loans moving into the 90-plus DPD bucket, especially tractors, meaning more borrowers are falling behind on payments.
What's their plan? Are they abandoning tractor financing?
Not completely. They explained they tightened underwriting a few months ago. Think those measures will kick in soon, leading to fewer slippages. But they also stressed the importance of the tractor segment, especially with the government's lending targets for the industry.
It sounds like they're balancing things, reducing risk but not giving up on tractors entirely.
Exactly. They're thinking long-term, recognizing the value of that segment. Let's get back to microfinance. Did analysts probe deeper, especially with those geographical differences we talked about?
They did. One specifically asked about warning signs in Karnataka, where new regulations have created uncertainty. Remember, their microfinance portfolio there declined.
Right. So are those new rules already impacting their business?
Seems so. They revealed that collection efficiency in Karnataka dipped about 1%, early signs of stress. But they also said it's manageable and emphasized their commitment to watching those regulations closely. Smart move. Always better to be prepared. Now, shifting gears, analysts wanted a clearer picture of the bank's overall deposit strategy. Specifically, their plans to reduce reliance on bulk deposits further.
Remember how they reduced certain wholesale deposits earlier? One analyst asked if that would continue and if deposit growth would be more in line with retail deposit growth going forward.
So, doubling down on building that more granular deposit base?
Seems like it. They confirmed they're sticking with reducing bulk deposits, even repeated their public guidance of aiming for an LCR ratio of 48% to 52% and an LDR of 88% to 90%.
Quick reminder, what do those ratios mean?
Sure, LCR, or liquidity coverage ratio, measures how well a bank can meet short-term obligations using its most liquid assets. Higher LCR means a stronger financial position generally.
So their target range means they want to keep enough liquid assets to cover short-term needs.
Exactly. And LDR, loan-to-deposit ratio, shows how much of their deposits are used for loans. A lower LDR usually means a more conservative lending approach.
So targeting a specific range for both ratios shows they want to balance liquidity and lending growth.
Precisely. It's all about managing risk and ensuring sustainable growth. Now let's talk about their digital efforts. Did analysts ask about their digital platforms?
They did. One was particularly interested in Indie for Business, their new platform, wanted to know about early adoption trends.
Me too. Did they share any numbers or stories about its success?
They didn't give specific figures, but did say over 10,000 users registered within a month of launch, highlighted its features and how it's tailored for MSME clients.
Promising start. Seems like they're gaining ground in the digital space.
Definitely. And it's not just new customers, they're also focused on engaging existing ones better. Analysts wanted to know how people were reacting to the upgraded Indie app for retail customers.
So are customers liking the new features?
Looks like it. The bank said the first 150,000 customers who switched to the upgraded app showed a 20% increase in engagement within a month. Suggests the upgrade is working, maybe leading to more product use and revenue.
That's a big jump in engagement. Their digital strategy seems to be paying off.
Absolutely. Attracting new customers and building stronger relationships with existing ones through their platforms. But banking is still about people. Analysts also asked about management changes, specifically a recent executive departure. Wanted to know if it signaled wider attrition at the top.
Valid concern. Stable leadership is crucial, especially in banking.
So how did they respond?
Both the managing director and the HR head emphasized their team's stability and commitment to attracting and keeping top talent. Acknowledged recent retirements led to a mix of new and experienced people taking on leadership roles.
Good to hear they're addressing concerns about leadership continuity. Before we move on to the final part, where we'll sum everything up and draw conclusions, what stood out to you from this Q&A?
Honestly, their transparency and willingness to tackle the hard questions impressed me. No dodging the microfinance problems or asset quality worries. They gave detailed data, explained their risk mitigation strategies, and expressed confidence in their ability to handle these issues.
Totally agree. That honesty and openness builds trust with investors and analysts.
Absolutely. It's a company that acknowledges its challenges and is committed to tackling them head-on.
I'm excited to hear your insights on what all this means for our listeners, but let's save that for the final part.
Sounds good. Let's take a moment to gather our thoughts, and then we'll tie everything together, giving you some actionable takeaways from Henderson Bank's Q3 FY25 performance.
All right, we've really gone deep on Henderson Bank's Q3 FY25 performance, explored their earnings call, their investor presentation, and even their raw financials. And of course, we just finished analyzing that intense Q&A session with the analysts.
It's been a journey. We've seen their shifts in strategy, their struggles, their wins. But now for the most important part. What does it all mean for you, someone interested in this bank?
Exactly. Let's connect the dots, get the big picture. First, we have to acknowledge Henderson Bank is operating in a tough economic climate. Especially in microfinance, they're facing some serious headwinds.
True, we've seen that throughout our deep dive. But the key is they're not just waiting and hoping. They're adapting, making strategic changes to navigate these challenges.
Their strong retail banking performance and commitment to digital transformation are perfect examples, not just riding out the storm, but building a stronger, more customer-focused model for the future.
And their careful approach to risk management is encouraging. Stable asset quality outside microfinance, healthy capital ratios suggest they're ready for potential bumps in the road.
Of course, we can't ignore the microfinance challenge. It's a real concern, something to watch closely in the coming quarters.
Absolutely. But they're not ignoring it either. They're being transparent about the risks and taking steps to address them.
They're giving detailed information, investing in tech and people, and constantly reviewing their strategies. Plus, diversifying their loan book, both geographically and by product, is a smart move. Less reliance on any single area helps if one segment struggles.
Their focus on building a strong and stable deposit base, mainly through retail, is positive too. Provides a good foundation for sustainable growth, less dependence on those shaky wholesale funding sources.
And their progress in digital is impressive, attracting new customers with innovative platforms like Indie for Business and engaging existing customers better with the upgraded Indie app.
These digital initiatives are essential for staying competitive. Shows they're not just a traditional bank, They're embracing the future of finance.
So what's the bottom line for our listeners? What should they take away from all this?
Henderson Bank is facing real challenges, no question. But they're also showing resilience, adaptability, and a drive to innovate. They're making tough choices and taking steps to set themselves up for success.
Some uncertainty remains, particularly around microfinance and how it will impact their performance overall, but they seem to be approaching it with a clear head and a solid plan.
Here's a final thought for our listeners. We've seen Henderson Bank's shift to a more granular, retail-focused model. But will that be enough to stand out in a crowded, competitive banking world?
What else might they need to do to really solidify their position and grab more market share?
Things to consider as we continue watching Henderson Bank's journey.
And that concludes our deep dive into Henderson Bank's Q3 FY25 performance. Hope this gave you valuable insights and a better understanding of where the bank stands now and what its future might hold.
Remember, knowledge is power. The more you understand a company's financials, the better equipped you are to make smart decisions.
So keep learning, keep exploring, and keep asking those tough questions. Until next time, happy investing.